Okay, so okay, those of you who don't have your videos on, you can put it on. Who got it? Let's start. Okay, thank you everyone. Let's get started. Today we'll do something else. Why? So let's get started. What are we going to do? Obviously today we will learn how to prepare cash flow statement. Okay, so let me quickly give you all a recap, because I'm sure you all are busy people, so you would have forgotten what we were doing in the last class. So let me give you a quick recap. What are we doing? We are trying to understand how to prepare cash flow statement. After the recap, of course, I will open it up for one round of questioning, and then we will start with the agenda for today. So we were trying to learn how to prepare cash flow statement. Now we said that the purpose of cash flow statement is that we want to track cash, where cash came in from and where it went. And we want to do it in two heads. One head is, three headings. One is called cash flow from operating activities. Then another is cash flow from investing activities. And then finally, we have cash flow from financing activities. Now, what's special about these? Basically, we want to have a summary information in certain meaningful classification. So as we discussed in the last class, that if we just have a T account of cash, then also we have all the reasons why cash came in and why it went out, but it's not available in a summary T format, which we can use to take our decisions better. What is the purpose of reporting? So that the decision makers have some information about the business. So for that purpose, we will be doing the same thing, but we will be doing it in a particular format, which is this format, that we want to classify the cash in CFO, CFI, CFF. Before I give you the full recap, let me remind you once again, or rather let me point it to you, that only those transactions which affected cash will come here. I think this is needless to speak, but nonetheless, I will tell you. For example, let us say you have purchased inventory on credit. Then did cash come in or did cash went out of the business? No. So that will never come in cash flow statement. Even though it is happening something, some important transaction is happening, but cash is not moving out, so we are not bothered. Only those transactions which affected cash. Now, if they affected cash, then if they are of operating nature, we will write it here. If they are of investing nature, we'll write it here. And if they are of financing nature, we will write it here. And in this, the word operating, financing, and investing have their day-to-day dictionary meaning. We said that for a reference, we said that if you look at our balance sheet, then in the balance sheet, if let's say I have written assets this side, liabilities this side, then in investing activities, I would want to write all the activities which change our long-term assets. So for example, if you are purchasing land, selling land, purchasing building, selling building, you are acquiring new plant, new machinery, you are selling existing plant, machinery, all the cash which is coming in or moving out, and it is resulting into long-term asset movement, is called investing activity. What did we tell you about financing activity? We said that all the activities which change long-term liabilities will be financing activity, CFF. What are the examples? Let us say you have raised new equity, or you have repaid existing equity, you have raised or taken new loan. By the way, just for a simple meaning, that whenever somebody say raised equity, means you have issued new shares and you have taken money from people. That's what we mean. So raised new equity. So financing activity. You have repaid existing equity, financing activity. You have taken a loan, financing. You have repaid loan, financing activity. Then finally we said that most of the items which appear in short-term assets and short-term liability, as well as most of the items in the income statement, belong to our CFO. Now, in this, we started looking at some of the exceptions in these two. We said that there are two exceptions. In general, all of these belong to CFO, but there are certain exceptions. So in the last class, we had seen some exceptions to short-term assets. We said one exception was short-term investment. If they are investment, then be it short-term or long-term, their effect will always come in CFI. And similarly, in short-term liability, we have one item called short-term loan. If you have a short-term loan, even that one is an exception to a short-term liability, that in the sense that short-term loans effect will always come into CFS. Okay, that means loan be it short-term or long-term, its effect will come in CFS. This is where we were in the last class. We also gave you the format. The format is going to be CFO, then we will write all the items, then CFI, then we will write all the items, then CFF, then we will write all the items. And when we add all of these together, these three grand totals together, then these three grand totals are our change in cash for the period. Once we have change in cash for the period, if we add our opening cash, then we should exactly get our closing cash, which is there in this year's balance sheet. This is the format of cash flow statement. So this is where we were in the last class. Before I start anything today, any questions? ठीक है, याद आ गया सब कुछ? Long back, almost 1 day back we did this. Let's get started with some of the exceptions which are there in income statement and why do we need to talk about it. Let us say, right now I'm not straight away going to the exceptions in the income statement, but rather I'm going to tell you something else. Let us say if I tell you to prepare a cash flow statement, okay, I have told you the concept and I have told you to prepare a cash flow statement. How you would have gone about doing it? Anything? Let's say you don't know how to prepare cash flow statement. Somebody just told you the objective and I am asking you to prepare it. What would you do to prepare it? Where will you get the information and where would you put it? In what manner? What would you start doing? Any intuitive understanding? Batao. Anything? Of course, if I have not even taught you, of course, there is no prize or penalty for wrong or right answers. Yeah, go ahead, Mala.
Sir, from journal entries.
From journal entries, we will pick what? From journal entries, what all we will pick?
Only cash transactions. What?
Only cash transaction. That is those transactions. Even T account is a good starting point. Yes. But then what will you do? After, let's say you have found out all the journal entries where cash was there, or let us say you have the T account of cash. Then what?
We'll segregate into operating finance.
Yes. Basically, why am I saying is that a lot of things you can intuitively do. So that's what I'm trying to bring out in this discussion. Okay. So then you will segregate CFO, CFI, or CFF. Similarly, if somebody is using T account, then even clever, then you have all the information at one place. So whichever item was CFO, you will write it in CFO. Whichever item was CFI, you will write it in CFI, and whichever was CFF, you will write it in CFF. Simple, fair enough, right? Let us say there is one item where you have paid some money to purchase certain furniture. क्या करेंगे? Let's say 30,000 का furniture का इधर लिखा हुआ. What will you do with this?
CFI.
इसको CFI में लिख देंगे. Straightforward. That's it. Simple enough. अरे कुछ चीजें अकाउंटिंग में सिंपल भी होते हैं भाई. Don't disbelieve me. Suddenly you guys are thinking कुछ तो trick है इसमें. Okay, trick is coming, but up till here it is pretty simple. That I have defined that what is financing, what is operating, and what is investing activity. You have purchased a piece of furniture, and then in your T account you found out that 30,000 has been paid for purchase of furniture. So you can simply make it up. You can bring this. Similarly, let us say there is 2,000 of purchase of inventory. इसको किधर डालेंगे? 2,000 का inventory purchase में खर्च किया है. What will you do with this?
Operating. CFO.
Operating. CFO में लिख देंगे. So basically, if you want it, you could look at all the transactions, then decide. It's almost like I can create a flow chart that look at all the transactions and decide whether it has cash or not. Oh, sorry. वो कैसे करते थे यार flow chart में? I forgot. Let us say you decide whether it has cash or not. If it doesn't, then you just ignore it. And if it is yes, then you decide further that does it have, I don't know, does it have CFO? Is it CFO or is it CFI or is it CFF? कुछ ऐसा सा पता नहीं ऐसा कौन फ्लो चार्ट बनाता है, but just try to play along. And then if the answer is yes, तो इसको CFF में लिख देंगे. Answer is here. If it is yes, तो इसको CFI में लिख देंगे. And if the answer is yes in this side, तो इसको CFO में लिख देंगे. That's it, done. Cash flow statement done. सीख लिया आपने cash flow. Then what we will do for 2 hours today? Unfortunately, this is just one method of preparing a cash flow statement, and nobody uses it. Why nobody uses it? I'll tell you in a bit. So whatever intuitively you have told it is exactly correct. Everybody could understand what I am talking about, but this is called a direct method of preparation of cash flow statement. To be more specific, a direct method of arriving at CFO. That means for CFI and CFF, the method is not different, but only for CFO. So this one is called a direct method. Now, if there is a direct method and I'm saying that nobody uses it, there must be one. Anybody can complete my statement? No?
Indirect method.
An indirect method, yeah. This is where the complications in your life start. There is one indirect method to calculate CFO. Basically, when somebody says that prepare the cash flow statement itself in indirect method, then the thing differs only for CFO. For CFI, whether you are doing it in direct method or in indirect method, it remains same. So basically, when we say direct versus indirect, we are talking about CFO, how CFO is calculated. Okay. Let me give an example to you. Let's say you have 3 transactions. Okay, or let us take one of the transactions that we had taken in yesterday's class. That sorry, one of the example that we had taken in yesterday's class, that there were 3 transactions. Let us say purchase of inventory for 20 lakhs. Then you sold this inventory for 40 lakh rupees. Then you purchased let us say machinery for 30 lakh rupees, and you have taken a loan taken for 35 lakh rupees. Only these 4 things happen. Okay. Let us quickly prepare the income statement and balance sheet. I think balance sheet we wouldn't need, but let us prepare the income statement. So can we prepare income statement for this company? Yes, only 2 transactions, purchase and sale. So I will say sales 40 lakhs and minus purchases minus 20 lakhs, and then you will have 20 lakh of profit. This is how income statement will look like. Okay. How will my cash flow statement look like? This also we had done yesterday itself. The cash flow will look like CFO. You will have in CFO you will have sales of positive 40 minus purchase, so negative 20, and that's how you have CFO of total 20 lakh. How is your CFI? CFI is purchase of one machinery. So negative 30 for CFI, negative 30 for CFI. How about CFF? CFF only one item, that is taken. You have taken a loan for 35 lakhs. This is supposed to look like 5. This one. Let me make it look like 5. Yeah. Okay. And you have taken a loan, so cash will come into the business. That is why positive sign. And that's it. This is what we had done in the last class. Then maybe you will go and check what was the opening cash or something, and then you will do it. This is how we would have prepared the cash flow statement using a direct method. Now, the problem with the direct method is that a lot of entries, in fact, in this particular example, if you look at CFO, and let us try to, in childhood, you might have played this game, find 5 differences or something in 2 pictures. So let us try to find 2 differences in this statement and this statement, the CFO and income statement. Are they looking somewhat different or same? They're looking different or same?
Same.
They're looking same. Basically, what happens is that because most of the items, look at the language I'm choosing, because most of the items in this income statement are going to belong to CFO, we say that there is no point in reproducing the same statement. That is why we do not prepare the cash flow from operating activity in this manner, but rather we go via something which is called an indirect method. So that I will explain, but before, one question. Yeah, go ahead, Sayam.
Sir, from income statement, it is not clear if it is on credit or on cash, but from cash to statement.
This is the part I was about to come. So right now it is, if both of these are cash payment, then it is clear. Yeah, so these complications I will bring. So which is what I was mentioning, which is what is the objective for today. So basically what Sayam noticed is that from income statement itself, right now in your example, you have taken everything is in cash, but in real life, everything might not be in cash. Let us say you have purchased for 20 lakh, but you have not paid for it, but still purchases will come here. The inventory purchase, COGS. Let us say you have done a sale of 40 lakh rupees, but you have received only 10 lakh rupees. But still, as far as sales in the income statement number is concerned, entire 40 will come here. Is samajh mein aa raha hai what he is trying to point out? He is saying that in that case there will be a difference. So this is what is the agenda for today, and that's what indirect method is all about. Okay, so let me tell it to you methodically. So what his point is going to come soon enough. Basically, if everything was in cash, assuming everything was in cash, then there would be a lot of similarity in CFO and in an income statement. Yahan tak to agreed hai? Yeah. That is why in practice we do not prepare cash flow statement via a direct method. What we do is that we prepare cash flow from operation via an indirect method. Now what is the essence of indirect method? That we don't do this, rather we start from the profit itself. That net profit itself, we say that this itself is our cash flow from operations. We say net profit is of 20 lakh itself is our CFO. And then we would want to adjust for the reasons why it is not. For example, let us say somebody told you later on that of the sales that you had done, only 30 lakh was received in cash and 10 lakh was not received in cash. I'm including one more information here. That let us say somebody told you that the sales that you had done, 30 lakh was received in cash, but 10 was not. So what you would do, first of all, you will simply write 20 lakh is my CFO, and then you would write that subtract 10 lakh for the fact that sales was not received in cash. Basically, we would go in a reverse direction. We will start with an assumption that this net profit itself is our CFO, and then we will adjust for the reasons why it is not. Fine? Yahan tak samajh aaya? Now let me elaborate. Basically, there could be a variety of reasons why there could be a difference between net profit and CFO. But fortunately for us, these reasons could be classified in only 3 headings. Only 3 types of reasons could be there why net profit is not my CFO. One reason could be that in income statement, some non-cash item is there. This everybody has seen. Just now we took one example. In income statement, some non-cash item is there. So we say them as non-cash income or expenses. Income or expenses. Similarly, in income statement, we can have something which are non-operating income or expenses. Non-operating income or expenses. Okay, I will write these 3 reasons separately so that you can make some notes. Basically, we are saying that we will start with, let's say I'm trying to calculate CFO. So first of all, I will write my first step would be, I will write my net profit here, something blah, blah, blah. And then I will do adjustment, that I will write adjustments. Now these adjustments are of 3 nature, type A, type B, and type C. What are these adjustments? These adjustments would be of 3 types. One is called a non-cash items, which are there in income statement, but because they are non-cash, that is why we don't need them. We need to reverse them. We need to adjust for them. Similarly, we can have non-operating items. And finally, we will have changes in working capital. Okay. I'll explain all of these one by one. Basically, what do I mean?